So let's just jump right in. We all tend to think that being a great investor is about picking the next multi-bagger stock, right? Finding that hidden gem. But what if the biggest risk to your portfolio, the thing that could really make or break your returns, isn't actually out there in the market, but it's right inside your own head?
Get this, some research suggests that a staggering 80% of your success as an investor comes down to behavioral finance. That's just a fancy way of saying how you manage your own emotions and psychology. Only about 20% is the technical stuff, the mechanics of buying and selling. It's a mind game, first and foremost, and today we're going to learn the rules.
All right, so if we're playing a mind game, you got to know who you're up against. And believe it or not, the toughest opponents are our own psychological biases. These things are like invisible forces, these little mental shortcuts that our brain takes. They feel totally rational in the moment, but they often lead us to make predictably irrational and, pretty expensive mistakes with our money.
Let's kick things off with a big one, loss aversion. Here's the deal. On a psychological level, the pain of losing 1,000 rupees hurts way, way more than the joy you'd feel from finding 1,000 rupees. It's not even close. And this simple fact is one of the most powerful and, honestly, destructive forces in investing, because it makes us do things that are completely against our own best interests.
Sound familiar? This is the little voice in our head when we're trapped by loss aversion. You're holding a stock that's tanking. All the data, all the facts are screaming that your original reason for buying is totally broken, but you just can't sell. Why? Because the pain of making that loss real by hitting the sell button is so intense, it creates this false hope that if you just hold on a little longer, it'll magically bounce back.
Oh, this is a perfect analogy. We've all been there, right? You sign up for that gym membership in January, you're super motivated. By March, you haven't been in weeks, but you keep paying that monthly fee. You know why? Because canceling it forces you to admit you wasted the money. It's the exact same logic with a bad stock. We'd rather just let it sit there, useless, than face the sting of admitting we made a mistake.
The legendary investor Peter Lynch absolutely nailed the outcome of loss aversion with this quote. Think about it. We get a little bit of profit in a great company, our flower, and we get nervous, so we sell it way too early just to lock in that small win. But our losing stocks, the weeds, we hold on to those forever, pouring more hope and emotional energy into them. We're literally doing the exact opposite of what a good gardener or a good investor should do.
Okay, next up is another tricky mental trap called anchoring bias. This is when our brain gets fixated on the very first piece of information it sees, usually a number, and then uses that as a reference point for everything that follows, even if that first number is completely irrelevant.
Here's a real-world example. Imagine you're hunting for an apartment. The landlord says the rent is $45,000. That number is now the anchor in your mind. If you manage to talk them down to $32,000, you feel like you got an amazing deal. But what if the fair market value for that place was only $25,000 to begin with? The anchor made you feel good about overpaying. We do the same thing with a stock's 52-week high, blinding us to its real value today.
And let's not forget our old friend, overconfidence bias. This one's sneaky. You have a couple of good picks, a few of your stocks go up, and suddenly you start to feel like an investing genius, right? It's so easy to mistake a bull market, or just pure luck, for genuine skill. And that's dangerous, because it leads us to take on way more risk than we should, thinking we just can't lose. Okay, so we've established our brains are basically minefields of bad decision-making. That's the bad news. The good news is we can design a portfolio that protects us from ourselves. So how do we do that? Well, let's explore two totally different philosophies for structuring your investments to manage that risk.
This quote from Warren Buffett just perfectly sets up the central debate here. It's the ultimate tug-of-war in investing. On one side, you've got the desire for safety, for preserving what you have. And on the other, you've got the ambition for rapid, life-changing growth. These two goals lead to very, very different strategies.
So let's really break it down. Concentration is all about making big, focused bets. You find a handful of companies you believe in with every fiber of your being, and you put a significant chunk of your money into them. The goal? Build wealth, and build it fast. Diversification is the complete opposite. It's about spreading your money out across lots of different stocks. The goal here isn't to get rich quick, it's to protect your capital and make sure that no single bad apple can spoil the whole barrel.
The concentration strategy is a lot like this poker hand. You're confident, you've done your research, and you are pushing all of your chips into the middle of the table. You're going all in on your absolute best ideas. Now, the potential payoff is massive, right? But if you've misread the situation, if you're wrong,
The consequences can be absolutely devastating. It is a very high-stakes game.
And that's because concentration is truly a double-edged sword. Sure, the upside is huge potential returns, and it's a lot easier to keep track of, say, 5 stocks than 50. But the flip side is brutal. You're opening yourself up to extreme risk and gut-wrenching volatility. This isn't a strategy for amateurs. It requires an incredible amount of skill, because just one bad call can wipe out a massive portion of your portfolio.
Now, you might be thinking, okay, a loss is a loss, I get it. But the math behind recovering from a really big drop is, well, it's pretty unforgiving. It's not as simple as you might think.
Okay, look at these numbers. If your stock drops 10%, you need an 11% gain to get back to even. No big deal, right? Manageable. But look what happens as the drop gets bigger. If your stock gets cut in half, a 50% loss, you don't need a 50% gain, you need a 100% gain. The stock has to literally double just for you to break even. And a 70% loss? You need an unbelievable 233% gain to recover. The deeper the hole you dig, it gets exponentially harder to climb back out.
And listen, this is not just some academic exercise. This stuff happens in the real world. Just look at this chart for Delta Corp. The stock plummeted, almost 80%. Now imagine you had a huge concentrated chunk of your net worth in that stock. This isn't just a minor setback. This is a catastrophic, life-altering loss. Coming back from that is next to impossible.
So what's the alternative to that kind of terror? Well, it's diversification. And I love this analogy. If you only have one food delivery app on your phone, and the one restaurant you pick gives you terrible food, well, your whole dinner's ruined. But if you have 3 or 4 different apps, one bad meal from one restaurant isn't a big deal. You've got other options. That's what diversification does. It ensures that no single mistake can completely torpedo your entire portfolio.
So it feels like we're stuck with a tough choice, right? Either you go for high-risk concentration or you play it safe with lower-return diversification. But what if you didn't have to choose? What if there was a way to get the best of both worlds? Well, that brings us to a really smart hybrid approach known as the Barbell Strategy.
At its heart, the Barbell Strategy is designed to let you have your cake and eat it too. It gives you a framework to make those meaningful, concentrated bets for that high growth potential, while at the same time protecting your downside with a safety net of other investments. It's all about creating a smart, deliberate balance between risk and reward.
So how does it actually work? Well, you basically split your portfolio into 2 distinct parts. On one side of the barbell, you have your core. This is where 40 to 60% of your money goes, into a small number of your absolute highest conviction stocks. Then on the other side, you have your satellites. This is the remaining 40 to 60%, and you spread that capital across a much wider basket of stocks, maybe some emerging ideas, with smaller position sizes for safety.
And even within that structure, you can get more specific. Your position sizing should be a direct reflection of your conviction. So your absolute best, most well-researched ideas, maybe they get a 6 to 8% allocation. Ideas you feel good about, but maybe not as certain, that's your 4 to 6% bucket. And those newer, riskier, more speculative ideas, you give them a much smaller slice, say 2 to 4%. This lets you get some exposure to their potential upside without betting the farm.
But you know what? Forget all the percentages and all the complex structures for a second. At the end of the day, there is one simple, unbreakable rule that beats everything else. It's the sleep at night test. If any single stock in your portfolio grows so large that you find yourself lying awake at night worrying about it, that's it. That's your signal. It's time to trim that position and rebalance. Your own peace of mind is the ultimate risk manager. Never forget that.
So, I'll leave you with this one last question to really think about. Take an honest look at your own investments. When you look at your portfolio, do you see a structure? Do you see a deliberate strategy that's designed to manage risk and, more importantly, to manage your own biases? Or is it just a random collection of stocks you bought based on a hot tip, a gut feeling, or just plain hope? The answer to that question could truly make all the difference in the world.